right. Good morning, good afternoon, good evening, everyone, depending where you are in the world. It's a pleasure to welcome you to the MeTTa Equiam presentation. Thank you for joining us. I'm Adrian Saville. I'm professor in economics, finance, and strategy. I'm a director of MeTTa, and I chair the investment committee to declare my conflicts of interest. So welcome. Thank you for accepting the invitation. Perhaps to get some housekeeping out of the way, for those of you who are in the investment industry and you're looking for CPD points, if you send an email to yolanda@grobest.co.za, you will earn CPD points for attending. The caveat is you have to attend to the end. And to get us from here to the end, our partners, Ziad, Makkawi, Joe Day, thank you for joining us. They look after Equiam Capital. A little bit about each of Equiam, sorry, a little bit about each of the businesses to set context. So Equiam is a private markets investment firm. They specialize in secondary transactions, which afford you the opportunity to buy into illiquid equity positions as earlier investors, including employees, founders, exit a business. There is an opportunity to participate in a secondary transaction, and that gives you the ability to enter as a later stage investor into venture-backed capital opportunities from Series B relatively early all the way through to a pre-IPO just on the cusp of listing. I think there's an intriguing aspect of the investment process, which is their systemic data-driven approach. That speaks volumes to my own investment approach, and look forward to getting their insights. I'm going to hand to Ziad and Joe in a moment to introduce themselves. MeTTa probably needs little introduction in this room, but just for the sake of completeness, what brings us together is we have partnered with Equiam's Private Tech 30 Fund to launch the MeTTa Equiam Private Tech Fund 30 Limited. And the structure enables South African investors to access exactly what I've described, venture capital from stage B through to pre-IPO, with US market leaders, $100 million plus in revenue. In other words, these are businesses of size and stature. The fund will be raised in South Africa and invested as a single LP into the US vehicle. The targeted internal rate of return is 21%, projected net of fees before taxes, with 1 to 3 year targeted holding periods. So welcome. I'm going to get out of your way. I'm going to ask Ziad and Joe to introduce themselves. Over to you, gentlemen.
Wonderful. Thank you very much. I'm going to try and share my screen. If you can just let me know if you see it, that would be great.
We've got it. Thanks, Ziad.
Wonderful. Great. Well, first of all, thank you all for giving us the opportunity to talk to you about the Private Tech 30 Fund. Maybe just a quick couple of intros. So as Adrian mentioned, Equiam is a San Francisco-based asset manager. We focus on growth and late-stage private technology companies. Although we do invest in different strategies from the B round all the way up to pre-IPO, this particular fund is focused on kind of the least risky portion of that, which is actually the late stage and pre-IPO companies. And it's meant to give you a diversified portfolio of these companies. In terms of my own personal background, so I've been in finance and an investor for more than 30 years. Started my career at JP Morgan in New York. I was a currency derivatives trader. I then became an oil trader, and then I moved to kind of proper investments in equities and fixed income. I've started multiple asset management firms, one of which I sold to Franklin Templeton back in 2011. I also used to run a sovereign wealth fund for the government of Dubai called Istismar, which actually brought me very close to South Africa. So I have a lot of very good memories because we used to own the V&A harbor or in Cape Town, Kerzner Group, like a lot of different assets in South Africa. We even had an office in Cape Town, and I'm a big fan. So that's kind of me, and I'll hand it over to Joe to give you a quick intro as well, and then we'll dive into the fund.
Thanks, Ziad. And so I second it. Thanks again for everybody for taking the time to listen to us. Unfortunately, I don't have as many good South African connections as Ziad does, but I will give you a little bit about my background because I think it connects a lot to why we're doing what we're doing at Equiam. So I started my career as a theoretical physicist. I was a visiting scholar at Stanford, and my wife became pregnant. Thought, okay, it's time to go get a real job. I went to go work at Bridgewater Associates, which is a big hedge fund here in the US. I spent a bit over half a decade there working on the investment team focused on systematic public equities across the globe. So we did, investments in South Africa and the public markets and things as well, but globally. Post that, a few friends of mine were starting a firm in California, a venture capital firm called Tribe Capital. Tribe Capital is a data-driven sort of early stage firm focused on seed, Series A type of companies. When I joined them, we were about 200 million under management. When I left, we were north of 1.5 billion. So it was certainly a fantastic ride and a great experience. And coming to the end of that, I sort of had what I thought was the epiphany of, wow, there's all of this great data that's going on in private markets. And as far as I had seen, people were not really utilizing it in the same way that people had been doing for decades in the public markets. So I talked to a friend of mine, thought about starting my own fund, and he said, hey, it's a fantastic idea. However, there's a few guys down the street from you that had this idea a few years ahead of you. Ziad being the founder, Equiam was the firm. So I connected with them, joined them, and the rest is history. So I now sit on the investment team at Equiam, been here for the better part of a couple of years. That's me.
Thanks, Joe. So, we'd obviously love to we're going to open it up for Q&A, but if anybody has like a burning question, please don't hesitate to reach out and ask. So, as Joe was mentioning, Equiam, two things differentiate us. One is that we're very much focused on data, on systematic investing, and on secondaries. So what we aim to do with this Private Tech 30 Fund 2 is to provide investors with a diversified access to about 30 late-stage pre-IPO names. They must have about $100 million in revenues. So again, like Adrian mentioned, substantially de-risked, and that we believe are close to a liquidity event, so an IPO in general. The access to this is obviously through a fund. And one of the key aspects of this particular fund as well is that we intend to provide co-invest opportunities. Many high net worth individuals and family offices like to, maybe add to a specific position that they particularly like. And when that becomes available to us, as it does often, we're actually doing one right now, those will be made available as well to people who participate in the fund. Our target position level, so on a deal-by-deal basis, we look to underwrite to IRRs of around 25%. We do that through structural pricing advantages in the secondaries. And we look at companies that, again, we're going to have an exit, let's say, within 1 to 3, 2 to 4 type of years, which is much, much shorter than your typical 5 to 7 year horizons for growth equity. And VC is sometimes even longer than that. Our North Star is really to generate good returns, but most importantly, quick DPI, which is basically short for cash back in your pockets. This is the biggest pain point today in the VC world, to a lesser extent in private equity, but even in the private equity world, people see these big numbers or not, but they don't get their money back for like 10 years, 11 years. And we're kind of the antidote. We're on the other side of that spectrum. Our focus is really very, very much on doing things in a risk controlled or understood way, disciplined through a systematic approach and rigor in the data that we do. that we use. So this is what I was talking about before. So again, not to be repetitive, looking for large companies, IRRs of 25%, and North Star being kind of DPI cash back in investors' pockets. We'll have about 30 pre-IPO companies, and investors coming into the fund will also have access through co-invest into these vehicles, into these companies. So this is the slide, excuse me. So I'll start over. So what we're trying to do here, you're seeing the slide, yeah? Okay. So what we have here is I tried to do a then and now, and to really show how the market dynamics have changed, and they've really changed dramatically. So if we look at the time when Amazon, Nvidia, and Tesla went public, what we try to do is show what were the revenue levels that these companies were actually generating when they went public. So in the case of Amazon, it was $31 million. And these are, by the way, inflation-adjusted prices. So it was actually lower. Nvidia, 56 million. Tesla, 167 million. Today, if you look at the companies that are still private, SpaceX is generating $13 billion on an annualized basis and increasing. OpenAI, 8 billion. This is through August of this year. And Databricks, 3 billion. So making a lot more money while they're still private. In fact, most companies have, in general, there's been less publicly listed companies. There are less publicly listed companies today than there were like 10 years ago. Because it's regulatory tailwinds. People don't want to be subjected to the same levels of scrutiny of regulatory quarterly disclosures, which they start working for very short-term gains when these companies, in fact, should be reinvesting for the future. So another way of looking at this is through is looking at it from a value proposition. So again, just to go back to Amazon, with $31 million in revenues, they actually IPO'd at a $430 million valuation. Nvidia, 480 million valuation, and Tesla 1.6. I want to contrast that to what they're worth today, which in the case of Amazon, we're talking about $2.3 trillion. In the case of Nvidia, it's $4.5 trillion of value. And in the case of Tesla, it's about $1.4 trillion. The difference between when they went public to actually where they are right now is value that public market investors could have captured. In fact, if you had bought Nvidia at the time of IPO, you'd be making, it's a 6,400 times return, right? Contrast that to the valuations of these companies that we had on the previous slide that are generating tens of billions of dollars, or billions at least of dollars. Databricks is worth $100 billion as it's per its last round. SpaceX, 350 billion, and OpenAI just did a round at 500 billion. And they're still not public. What does it say? It basically says the value creation that is taking place right now is taking place when the companies are private. And what that did is that it precluded a huge swath of investors from accessing that value creation. And that in turn, basically, that's kind of the big change. So you need to be investing in the private stage. Maybe you don't go all the way to kind of seed and early stage unless you actually like that level of risk. But if you come in a little bit pre-IPO, late stage pre-IPO, you get to play in that value creation or to participate in that value creation. So what does that do? What does that do in terms of these companies staying private longer, doing multiple rounds? It used to take, from A round to IPO, Amazon took 4 years. Now companies are staying private for 10 years, 12 years. So what that did is created liquidity pain points for early stage investors, the founders, the employees who didn't have a way. They were rich on paper, but they didn't have a way to monetize that. They didn't have a way to buy a house or send their kids to school or whatever liquidity event they wanted to. Or more recently, VC funds themselves are running out of their lifespan, and they need to give back money to their LPs, so they're coming to the secondary market. All of this activity, increased secondary activity, increased primary rounds, generates all of this data, which we have been harnessing, collecting for the past 8 years to rely on for screening, or trying to find what are the kind of the patterns that make for a successful company, and so on and so forth. So 2 things, data and liquidity. The secondary market, by the way, has grown substantially. It's probably in the $150, maybe even $1 billion per annum, and more people are using it. I'll hand it over to Joe, and he's going to tell you a little bit more on the Equiam process and track record. If anybody has any questions before that, please let us know.
Thanks,
Okay.
Ziad. Thanks, Ziad.
Yes, go ahead.
So moving on to the next slide. You know, when we say that we're data-driven and systematic, I think we should drill in a little bit to exactly what that means, because I think particularly in this market, you know, everybody says they're data-driven. Some of them are, some of them aren't. It really just depends on what your definition is. So I think the best thing for us to do is lay out at a high level what our general process is, to give you insight to the way that we think about it. And then obviously we can drill down in whichever direction you want during the Q&A. But our initial process is we consume huge amounts of data. We get data from several thousand companies in the private market. I mean, almost 10,000 in fact, but about 3,000 that we consider reliable and robust and with a deep enough data set that we can do something with. Of course, those are usually typically sort of the biggest, most well-known companies. We get data, fundamental data from them. So those are things like financials. We also get secondary data sources from them. Things like PitchBook you may be familiar with. This is somebody who keeps track of round data. We look at things like Privco, which has other sort of operating metrics. We also ingest a lot of alternative data. So these might be things like what's going on at the headcount of a company, what's going on with particular roles. Are they hiring more engineers? Are they laying off salespeople? So all of these things we can use to look at a company in isolation, but we can also use it to compare companies one against another, like for like, to understand certain dynamics of a particular company. It's also useful, as you can imagine, a company that may be 3 years ahead of another company. What might the trajectory of that company look like? So once we have all that data, the first step is we just create a hit list of every company in our data set, which is a very large swath of the private markets. Because we are able to access companies through the secondary market and the primary market, by the way, our historical split has been about 70% secondary, 30% primary. We're able to invest in companies whether or not they're raising. As you likely know, most companies aren't raising, and many good companies aren't raising rounds. Even if they are, sometimes deals can be very hard to come by. It's often sort of a who you know. We've gotten a lot better at that as we've sort of evolved as a firm, hence the 30% primary. But you know, some of these very good companies, the cap tables are extraordinarily tightly controlled. But for us, because of our sort of secondary market expertise, that doesn't matter. We're really able to access really the who's who within the world. So once we've created our hit list and we decide who we think the top names are, the second thing is to go out and source those deals. So the way that we source them is across our desk, we get about 600 deals every single month. Obviously, it's not just myself and Ziad. We have a host of other investment folks that are working with us. We either go outbound for the companies that we like, but we also get inbounds. We have a very robust network of secondary brokers that we work with, investment banks, early stage employees, you can imagine founders, maybe some of the C-suite, as well as the companies themselves, once they sort of know that we're in the market and we've built out those relationships from them. So once we get the information from those companies, from the companies that we want, we will ask them for first-party financials. We will never do a data without first-party recent financials. Because as you can imagine, I listed out that whole list of 20 plus data sources that we ingest. anybody who's worked in this market or worked in data in general, you know sometimes the data can be wrong and sometimes grossly wrong. Of course, we triangulate that data to make sure that we're in the ballpark, but we won't put a dollar in play until we have those corroborated financials and know that our numbers are right. So once we have that data, we bring it in sort of our in-house analytical suite. So we built out a whole suite of tooling that helps us understand essentially every line item of what the company's doing, everything from revenue to costs, and we build out different scenarios. So those scenarios might be what the management thinks they're going to do over the next 3, 4, 5 years. Then we'll have a scenario of like, what if everything goes wrong? What does the bear case look like? What if everything goes right? What if this company is the next NVIDIA, Amazon, what have you? And that may be another case. And then we'll build out a host of cases in between, depending on the style of the company. What'll happen if interest rates increase more than expected, decrease more than expected? And you can run the gamut depending upon what the company might be. So once we've done that, we produced a whole suite of analytics that also produce valuations. So we go and we use our research to assign probabilities to each one of those cases. And the output of that is some sort of expected value or sort of a fair value across all the scenarios. But we also sort of heavily debate each scenario, knowing that, of course, the probabilities are a range and nothing is going to be overly precise. The beauty of that valuation process is we're able to really understand how small changes to certain line items might grossly change the outcome of those companies. Another thing that our tooling does is, as many of you may know, what the shares you buy in the private market, they're not like what you buy in the public market. The price is not the price. Somebody may be selling a Series E pref share, which that might be a type of share with a lot of built-in protections, where the initial investor may not lose that much money, and you may be somehow shielded from certain events, and particularly being diluted, as one example. Many times employees that are selling have a lot of common shares. Those are often not very well protected. So what we're able to do is figure out exactly what share class is being sold to us, and very quickly, when I say very quickly, within seconds, reprice every single scenario. And then from that, we're able to really analyze and debate what is a fair value for this company. So the output of that analytical suite is one set of tools we call the projection tool. We also produce an in-house internal deep dive memo that looks very much like what you would expect from a classic venture capital firm or growth equity firm. Typically, that's around 30 pages, but obviously we don't care about the page count. We care about the depth and detail and understanding of what's in that memo. In addition, we will leverage expert networks. So you can imagine for maybe sort of internet, AI, cybersecurity, we're smart guys, but look, we're not going to know as much as somebody who's worked in that industry for 5, 10, 20 years. So we'll talk to those people, we get calls and really understand, the unknown unknowns for us, and then use those things to dig in deeper. The output of all of that goes to all of our investment committee members. And then we sit there and debate the merits of the company. At the end, we decide, is this a company that's worth pursuing and a company that we want to invest in? And most importantly, at what price? Because particularly in the secondary market, sometimes the price is set and it's a take it or leave it situation. But in the secondary market, there's often room for negotiation. And when we show up with our suite of information and say, look, we think this is a fair value, it's often very helpful in the conversation. So once we've decided on that, we move forward with the investment. Once we've decided to invest, we run it through a portfolio construction process. So we've built out a whole analytical suite as well that helps us understand portfolio construction within the private market. We've sort of taken the best of what we think exists in the private market and combined it with a lot of, what folks have done for decades in the public market. I spent a lot of my time when I worked at Bridgewater thinking about portfolio construction, doing analytics on that, because as you can imagine, that over the course of a fund, that can make a huge difference. So that helps us with our position sizing, and so that's sort of the soup to nuts process at a high level. Obviously, we can go deep down, but we'll save that for the Q&A. So the outcome of this is now our second fund offering of this flavor. I'll briefly touch on what we have done in our first fund. So as Ziad said, our North Star is DPI. That's cash back in your pocket, cash in the bank. It's not, funny money paper marks, right? We all like it when paper marks go up, but we all know they're paper marks, particularly in private market. So this is cash back in the pocket. In our first fund, there's a 2019 vintage. We produced so far a 1.84 DPI with a 28% IRR. To put that in context, Cambridge Associates is sort of the industry standard for benchmarking funds of particular vintages. Our DPI metric is in the top 1% across all the thousands of funds that they track. So, it's not my opinion, it's quite good. To give you an idea, as I said, we can invest in almost any company that we want. When Fund 1 was around, nobody knew us, even less than now. The companies in the middle here, the DoorDash, Stripe, SpaceX, these aren't toy examples. These are the companies we actually invested in. Snowflakes, Palantirs. These are sort of the who's who and the household names of the private markets. And the ability for us to invest in these alongside tier one venture capitals, the benchmarks, the insights, the light speeds of the world, the ones that you will know, we're able to sit along with them in these investments because of our sort of skill within the secondary market. So with that, that's a broad overview of our process. I'd love to sort of chat more on it as we get into it later. But I'll pass it back to Ziad for some particulars on the fund that we're offering today.
Sorry, unmuting myself. Can you guys hear me? Sorry. Okay, cool.
Yeah, we got you.
Great. So as Joe mentioned, I mean, this is not theoretical about what we think we can do, et cetera. This is something we've actually done in that portfolio, the Private Tech 30 Fund 1. We invested in 38 companies. We had more than 30 exits, 24 IPOs. We had exits or one exit through an M&A. And most importantly, I think that's another feature we don't talk about enough, is that we also have that optionality of exiting if we came in through the secondary market, or even if not, we can exit through the secondary market as well. Sometimes the market gets overhyped, prices go way beyond what we think they should be. And we have had no problem of exiting before that and giving back the investors the proceeds. Sorry, just let me. Okay, so again, just to touch on the criteria. Criteria for what we will do with the Private Tech 30 is we will choose 30 out of the largest 100. Why 30 and not the largest 30 is because what Joe was talking about, it has to be at the right price. We have to have the right financials. And the reason why we're going for larger size is because late stage VC-backed private companies fail about 40% less than their earlier stage counterparts, shouldn't be a surprise, and exit 50% faster back to kind of the DPI North Star. In terms of quality, even though we trust our process and our investments and our pricing of things, most of these companies have tier one VCs that have invested with them, that sit on their boards, that also push them towards value creation and also push them for an exit, which is also very important for us. And there is, statistically, we've looked at the data, and there is definitely a correlation between having more than one tier one VC or the same tier one VC reinvest or coming into multiple subsequent rounds with the returns. In terms of valuation, I think Joe went into pretty much a lot of depth on how we come up with what we think the valuation is going to be. Just to give you guys an idea of what are the type of companies that today would fit within this this size and quality bucket. So again, companies that you may have heard of, some you may not have, but Stripe, which is obviously a payment platform, Revolut, digital bank, fintech super app, SpaceX, Canva, Anthropic, one of the, I think it's literally the second largest LLM platform after OpenAI. Ramp is into corporate credit cards. Rippling is in HR. Databricks is basically the infrastructure for AI, data lakes for the whole kind of AI industry, I would say. Abnormal is more like cybersecurity. And so all of these companies are kind of in the top 100. So we're not saying we're going to invest exactly in those because they do have to meet specific criteria. Now, just to kind of conclude on the fund terms, we're looking to raise anywhere between 50 to 100 million. Our last two funds were 50. We could literally, the size of the fund isn't that important. We could work with 20 million as we could work with, 300, 500 million. It only changes the check size that we put into each of these companies. The fee structure is the 2 and 20 with an 8% annual performance hurdle for the carried interest. And typically, depending on where we end up with the final amounts, we will be writing checks of between $1 to $10 million. The investment period is 3 years. Most likely, we will do it faster unless something happens in the market. But the important thing is that we do not recycle. So in other words, if I invest in a company today and they IPO in a year, I'm not going to take that money and plow it back in. I'm going to distribute it to you. And if you like what you're seeing, you'll put it into our next fund. Fund life is 6 years plus 1+1, which is pretty much half of what a traditional VC is. So again, we want to make sure that we have a good concentrated timing of what the fund is going to, over the period of which it's going to execute, where we've chosen tier one auditors, fund administrators. SS&C is one of the top fund administrators in the world. So to conclude, I would say waiting until IPO leaves massive value on the table, as we saw earlier, while investing into private companies too early exposes investors to excess risk and tied up capital, sometimes for 10 to 15 years, before you get actually meaningful distribution. We apply a disciplined, rigorous underwriting process with secondary market execution that we've demonstrated a track record in doing well. And we will be curating a portfolio of about 30 names with an exit on an individual company level of between 12 to 36 months. We're DPI focused. We don't recycle capital. And when we generate cash flow, you receive those flows back. So that's the presentation for you. And I'll hand it over back to Adrian or anybody who wants to get into the Q&A.
Thank you, Ziad. First, if I could invite any questions, if you could pop those into the webinar chat, that would be great. It'd be lovely to hear questions, thoughts, concerns, clarification. And perhaps while we're waiting for those questions, I could put 3 to you briefly. The first is you talk about building a portfolio of 30 names. Can you perhaps give a sense of how big the universe is that you're looking at? 30 names out of how many people, if this is playground picks?
Yeah, so in our universe, we look at over 3,000 companies. But wow. This strategy in particular is saying we're going to give you 30 out of the top 100. So if the short answer to your question is, the investable universe for us is 100 companies, and we're going to pick them on the basis of which tier one VCs in there, are they being priced at the right valuation as per our assessment.
Great, thank you. There's a number of questions in the Q&A, so I'll come to those in a moment. Just please keep populating those. You obviously enjoy a distinct network advantage that you're able to access these. Is that something that you're able to sustain, protect, that you afford these? Surely this isn't a sort of a first come, first served. How do you access these?
Yeah. So as mentioned earlier by Joe, we access them in multiple ways. The secondary market itself is a real thing. This is not new. In other words, there's platforms where there are people who are putting bids and offers. It's almost like a electronic over-the-counter type of exchange. The settlement isn't like electronic yet, but that exists. You have companies like Forge, like Caplight, like NASDAQ Private Market, where even companies come to do tender offers. Now it's become a feature and a necessity for companies actually to offer their employees liquidity events. And those typically happen in an organized fashion through these they call them tender offers. So the market is really growing. So there's no chance that, if anything, our access is increasing, because as we grow in size, as the funds that we manage grow in size, and as we become better known, already we're seeing about 600 trades a month. And for us, it's very easy because we've already screened the universe. Our screening is about throwing things out, not about making investment decisions. So I would say that access is going to increase, not just for us, but even for other people through secondaries. The democratization, if you will, of this asset class is happening. There's regulatory tailwinds for that. And so you got to think that the private markets, especially the later stage segment of it, the line between public and privates is getting blurred. And so that's a very important thing, which is why it's not just about access. It's really about how you're underwriting, how you're making sure that you're buying things at the right price, especially in this type of an environment.
Great, thank you. There's a fair raft of questions in the Q&A. So Ziad, perhaps if we could sort of deal with these fairly succinctly, and if anything requires more depth, we can divert to a private conversation. I'll just run through them in the order that they presented. From Anonymous, a key attraction of the secondary market is the ability to access quality assets at a discount, often driven by liquidity pressures and so-called zombie funds. However, when the underlying includes such high-profile names that remain in the public spotlight, wouldn't investors be less inclined to sell at a discount given the upside potential is widely recognized?
Look, this is a great question, and I'll answer it the following way. And this is why we have an advantage, actually. The reality is this: people need liquidity for all kinds of reasons. And typically what happens is it's the liquidity that drives the need to sell. And typically there's something on the other side of that the seller wants to think. People are not coming in, especially if it's an employee or a founder, they're not going to come and sell like 50% of their position. That would be really worrying for us, actually. But they will sell 3% or 5%, right, of their position. Now, the advantage we have, and this is what the first slide was saying in terms of pricing advantages, is that you do, in fact, get discounts because there are not a lot of people so you either have really big players that are like, have billion-dollar funds, and nothing below like a $40 million or $50 million check moves the needle for them. And then you have kind of a more retail type of audience, which cannot invest $1 to $3 million. And so we're in this really sweet spot of being able to get the discounts we want. And we're not in a hurry. If we don't get the price we want, we just won't trade. We've done that multiple times. And people have actually, first of all, told us to go pound sand, and they told us we're nuts, and they tried, and then ultimately they came back and they traded at our price. This is not the rule. I'm saying this happens, but it's not always going to be at a discount. We don't care if it's discount or premium. We care about, is it at the fair market value that we feel this company is worth? Of course, we'll try to get it at the best price possible.
Oh, got it. Another anonymous: where, why, and how are private companies making their data public?
Yeah. So let's say, for example, anytime a company does a round, typically there's a filing. Companies like PitchBook and Preqin and others, they collect that information. Very often we see those trades, these funding rounds as well. And so typically if they're doing a funding round and they are talking to investors like us and or others, they will share the financials. The second, so that's kind of primary direct from the company financials. The second is in the secondary markets, you have these platforms that I told you about, like the Forges and the Caplights of the world that are actually posting every time there's a trade. It's recorded. Now, one of the things when I started Equiam back in 2018, I did a deal with a couple of those guys, including Forge, to give me all their transactions, all their bids, all their asks in terms of as a data feed. And so now we've expanded that to multiple brokers. So we're on the receiving end of now secondary data, right? And between the primary data, the secondary data, whatever's available in the public domain, sometimes CEOs or CFOs come out and they say, you know, we did $4 billion this quarter or whatever it is. So we look at all of that data to kind of form somewhat of hopefully a well-educated decision.
Thank you. Ziad, I'm keen to get through as many of the questions as possible, so I'm going to have to start restricting you to tweet-sized answers, 140 characters and less.
Yes and no.
Yeah. How often is the portfolio marked, and what valuation methods are used across the various rounds, across rounds?
So we have a valuation committee, depending on if the companies in our portfolio have done a round or not, or if they've transacted on the secondary market, or if another mutual fund, for example, has priced it. So that's our valuation committee. We do this quarterly, and we do full audited financials every year.
Thank you. A question around valuations or concern that is this perhaps another speculative bubble forming, that valuations might be rich. How do you manage that? What's the discipline?
Yeah, Joe, you want to take that?
Yeah, I'm happy to, I mean, as you can imagine, Adrian's going to hit me on the head if I give a long answer, so I'll give a short answer, but it's a great question and one we think about deeply. But the short answer is there's absolutely bubbles approaching. How do you think about a bubble? Well, you can look at it compared to historical companies in the same space. You know, we're students of history, but also for new technologies, things like AI, OpenAI. How do you know if they're in a bubble? Well, so we look at the fundamentals. We look at what's going on with the revenue. We look at sort of what's projected, what's priced into that price. OpenAI at $500 billion. How are they priced to grow, and how likely is that to happen? And so we spend a lot of time thinking of that, which is why the valuation process is so important for us, because there's absolutely pockets of exuberance in the market. But there are a lot of places where people maybe aren't looking, where things are more fairly priced. And by the way, sometimes we do think the pockets of exuberance are justified. We are investors in Anthropic, and we've already had a great return on that. So the short answer is very carefully, but it's a very important question.
Got it. Thank you. There's some familiar names popping up. Maxim Bailey says, what's your portfolio construction method, if you could speak to that?
Sure. Very briefly, we start from first principles of what are you trying to achieve through portfolio construction, right? You're trying to sort of smooth out the returns of the portfolio. And how do you think about important concepts like risk, correlation, and how do you balance those things, right? Things like modern portfolio theory, CAPM, don't quite apply. At least we don't have the information for it to work. So again, going back to first principles, going back to data, we're able to say, what do I talk about when I care about risks? Do I care about the standard deviation of some company? No, I don't give a shit about that. I don't want to lose money, and I certainly don't want to lose a lot of money. So because of our data, we're able to look at actually, this is where the 10,000 company data set comes in. We're able to look at distributions of companies across rounds at revenue levels and say, from a probability perspective, at least historically, how risky is the company based on a host of metrics, and where do they fit in? Of course, nothing is gospel. We look at it and we say, where does this company rank analytically? And then we say, is this company different and why? And that is a whole long conversation that we have within our investment committee.
Yolanda, you'll have to send me a clock in a private chat just to let me know how we're doing with time. And Jeff, if I could also have you on standby, there's a couple of questions that I think are specific from a South African perspective. But for the moment, Joe and Ziad, you've got some scars. Every investor has battle scars. We work 23andMe. What did you learn?
Well, this was kind of in the first fund. One of the learnings is that, first of all, in any portfolio, you're not going to get them right all the time. And again, this was a more systematic investment process of buying the largest, whatever, 30, 38. So we've had many learnings, including looking at the how binary returns can be, right? Well, a company could be worth 0 or 1, or it could be a company that has a tighter band of potential valuations. So whether it's 23andMe or WeWork or every single company was a learning, and the most important thing for us was to take those learnings, go back to our algorithms, go back to our screening tools, and say, okay, we got this wrong, let's fix it. And so anybody who's coming in with us now is coming in with the benefit of truly a lot of experience in this. Having said that, you have to assume our success rate was about 65%. In other words, companies made money. Still, you had 35% that lost money or made no money. In VC, it's an excellent.
Yeah. Perhaps yes, no answers. Do you pursue board seats?
No.
Okay. Management fees, committed capital or deployed capital?
Sorry, what's the question, Adrian?
Are management fees on committed capital or deployed capital?
Yes. No, management fees are on committed capital. And then after the investment period, it's on the remaining committed. So once we start distributing back, the management fees come down.
Okay, thank you. Temba Muddy has got a question around co-investment options. Temba, I imagine that these are on larger capital amounts, so perhaps we can put that conversation into a sidebar, just in the interest of time. I'll ask that you are connected for that conversation. Rory, Jeff, I think we're with you now. Rory says, what's the minimum investment? If you're a South African investor, would it form part of your discretionary offshore allowance? Would the funds be returned in rands or dollars? Similar question, minimum size. Who are the main LPs? This goes to Joe and Ziad. Who are the main LPs? States, institutional investors, retail, high net worth clients. Peter Armitage is here. Do you invest in rands offshore? That's back to the earlier question for you, Jeff.
Okay, so thanks, Adrian. So thank you guys for all the information. Very interesting. What is the mechanics in order to get into this MeTTa Equiam fund? So we're very lucky, I think, as South Africans to be offered this opportunity, because I think no matter how sophisticated you are, that's unlikely that as a typical South African investor, you would be offered this type of opportunity to get into a portfolio of these top 30 unicorns, so to speak, with 100 billion rand turnovers, etc., etc. So what we've done, the mechanics, is that a South African public unlisted company, MeTTa Equiam Top 30 Fund, has been set up, which has investors, South African investors, will subscribe for shares in rands into the SPV. The SPV has applied for exchange control approval to be one LP in the MeTTa Equiam Fund in Delaware. So there's no need for using foreign exchange allowances. It's all done in ZAR. The minimum investment is 1 million rand. So sophisticated investors. There is a qualification that that the American fund is looking for qualified investors. The fees are 2 and 20. Grovest has a fee sharing arrangement with MeTTa Equiam, so there are no other fees. It's 2 and 20. As Ziad says, as money is returned, or they have made any disposals of their investments, money will be returned to the LPs, in our case, to the South African SPV. We're quite lucky as well. I assume that the rate is quite favorable at this point in time, 1730. Should the rate worsen, in other words, that it goes anything above 1730 and the money gets returned to us in the next 3 years, in addition to the IRR that the fund will make, there should be a currency gain in the South African investors' hands. How does one actually invest? One would fill out a subscription form into MeTTa Equity. I think there is a website on the MeTTa Capital website. You can actually download the various forms. Otherwise, it's apply@mettacapital.co.za. Alternatively, you can reach out to me at jeffm@grovest or Tivin@Grovest.
The email is there. The email is up on the screen, Jeff.
Yeah,
apply@mettacapital.co.za.
and or me personally, jeffm@grovest.co.za. I'm happy to jump on a call. I'm happy to have a cup of coffee with you. There is a time frame that that fund closes on the 30th of November. I mean 30th of October. Sorry, Ziad, I saw you right there. 30th of October. So we all funds that need to be invested and banked into the South African bank account of MeTTa Equiam by the 30th of October, whereafter we would then make a subscription as one LP, as I said, into the Equiam fund. I don't know if there's anything else that any questions or anything that I need to cover.
I think you've covered it for now, Jeff. And if there are questions, people can pop them to that email. That would be my invitation. Maybe I could just flip back very quickly to Joe and Ziad. Question from Rory. Can the fund borrow money or use leverage? And then also, if you could just speak about the investors that you have, institutional or individual.
Yeah, so no, we don't. There's no leverage on the fund, and the LP base is pretty mixed. We have both large institutional financial investors in general, our LP base. I mean, so we have financial institutions from Asia. We've got hedge funds from New York. The bulk of our LPs though are family offices and high net worth individuals, because as you can see, this is very much a product that fits into kind of providing people with that diversified exposure.
Thank you. I'm going to watch the clock very closely. We promised a 4 o'clock close. We are there, and let you get back to your commitments. Thank you, everyone, for joining us. Ziad, Joe, Jeff, thanks for your contributions, participation. This looks like an absolutely fantastic opportunity. And to the Grovest team, thank you for looking after us in this webinar.
Thank you. Thank you all.
To you, Adrian, for hosting this webinar, and obviously to Ziad and Joe for your information. And we look forward to being part of your business.
Wonderful. Thank you very much, gentlemen. Thank you. Take care.
Just by the way, should anyone want CPD points, please will you send an email to yolanda@grovest.co.za, and then she'll be able to allocate you CPD points that you may require. But then thank you for everybody's attendance and look forward to engaging further.